Welcome back, everyone. I'm Philip here from BlackBull Markets. Hope you're doing well. Scaling out of trades is the topic we'll be talking about today, guys. So make sure to stick all the way through to the end of the video to see how we can successfully do it. We'll talk about ways not to scale out and how they will obviously affect your trading badly, and we'll also talk about the best ways or the better ways to scale out of your trades. So make sure also smash that like button, guys, and subscribe to the channel if you guys are interested in learning more about Forex and improving your current trading skills. So without further ado, let's have a look on this whiteboard to see what we can discuss about scaling out. Now, scaling out is a bit more difficult than scaling in. Now, if you guys did watch our previous video on scaling in, if you haven't watched it, go check it out. We did a whole video on scaling in on our trades. But if you have watched it, scaling in is a little bit easier because we have set structures that we can get into. So, for example, just a quick example here of scaling in on your trades. Obviously, if the market comes up and you have your first entry somewhere down here, because let's say when we maybe had a head and shoulders pattern play out or something, or a zone re-entry or whatever. So your first entry, obviously, and then we have a resistance being created, and you can go into your second entry over here. Then we might have like a breakout of the zone. You can have your another entry over here, and whatever patterns you have, you can scale in on that trade, and then eventually have a nice, a fairly big trade to play with. But scaling out is a little bit more difficult because it does, we have to be able to let the market run to a certain target, which could not always be achieved. Okay, so scaling out is a little bit more touchy. I prefer to rather close my entire position when it reaches a certain target. It's very rare that I scale out of a trade. I'll scale into a trade, but like I said, it's very rare that I'll scale out of a trade because I like to have that full profit target. But some people do like scaling out of a trades to secure some profits. I do know a lot of shorter term traders like day traders or scalpers like to scale out of their trades to protect themselves. But I want to quickly cover a scaling out system that I tried when I was fairly new to trading, when I first tried it to scale out of a trade, and why it didn't work and how it did end up not working out so well for my trading. Okay, so essentially what I did was, let's say, for example, doesn't really matter what the entry was. Let's say we have a consolidation zone. The market's now broken out of this consolidation zone. We've got a retest in this area over here. I took my first entry, and let's say I've got my stop loss. I've got a 1. Let's say my stop loss is, for argument's sake, 10 pips, right? Now, what I used to do in this, I would let the market run to a 1-to-1 risk-reward ratio. So what that means, I'll let this market run 10 pips, and then I would actually close half the trade. Okay, so I'll close half my trade. So let's say if I went in with 10 lots, for example, I would then close 5 lots as I reach a 1-to-1 risk-reward ratio, and then I would move my stop loss to break even, which seems fairly reasonable. At the time when I was thinking about it, it seemed fairly reasonable. But the issue was, now if the market did come out and stop me at break even, I essentially, where I could have made my certain amount with a 10 lot trade, and I actually made half of this. So let's say if I went in with 10 lots and I made 10 pips, or actually let's put it this way: if I went in with 1 lot and I traded 10 pips, I would have made $100. Okay, so if I went in with 1 lot, 10 pips, I would have made $100. But now, because I half that trade and now it's come back down to stop me out at break even, I essentially only made $50 on that trade, right? So this means what happened was, if my trade was not to be a successful trade, let's say I took the same sort of setup and the market ended up stopping me out, I would lose $100, obviously, because that was my risk reward ratio structure. Okay, so you guys can really kind of see what this is. I'm a big advocate for good risk reward ratios. I like to trade with a 3-to-1 at least risk reward ratio when I trade. But this obviously completely changes. So what happened now is my winners were half the size, if not a little bit less, than my losers. And this essentially brought down my average winning. And it also means that my accuracy of my trading, so I'm 50% accurate when I trade. So what that means is, when I take a trade, 50% of the time I'm wrong and 50% of the time I'm right. That's why I need a high risk reward ratio. This is very common in swing traders. And now what I've done, I've pretty much halved this, which means I have to increase my accuracy to be able to start actually making profits. And this is a really bad structure, and I cut this out very quickly and removed that from my trading strategy very, very quickly. This was when I used to do a lot of day trading or scalping, for example. I was very common using that, because with scalping, generally speaking, you're sitting, let's say, on a support zone, and you're looking for one quick push up, and then eventually, the market does pull back. So that was a reason for it. But when I decided what works better for me in scalping, I'd rather just, as the market pushes up, as soon as I start to show rejection, I'll just close the entire position right there to make sure I bank the right amount of profits. So that's one way to not scale out. I believe, it does decrease your accuracy. It does decrease your profit, which means you have to increase your accuracy, which is actually extremely hard. When we speak with people who do struggle with their trading, who really struggle to see consistent profits, most of the time it's nothing to do with technical analysis. If you've been trading for a year plus, even 6 months plus, your issue, I can guarantee you, is not with your technical analysis, because you should already have a fairly based understanding of the market, whether it's based off of price action, whether you're using indicators, or anything along the lines of that, whether it's news. Guys, the biggest issue with most of the people who are unsuccessful in trading is their risk-reward ratio. So just be aware of that. That's something you need to work on. Now, let's talk about scaling out of a trade. Scaling out of a trade, I believe the easiest way to scale out of a trade is to use a moving average. Okay, we'll talk about other technicals as well, but a moving average I like to use is the 8 simple moving average. Okay, that's a good moving average if you do want to scale out of your trades. Okay, so what we'll have is, let's say we took a trade here again. We had a nice head and shoulders down here, right? Any sort of support that the market's on, we took our trade, and now the market's starting to move. Okay, it's starting to give us some nice moves. Now, when we want to start scaling out of this trade, let's say we've got our 8 simple moving average. I'll change it to blue so we can see. Maybe I'll change to purple so we can see a bit better, or red. So we've got this 8 simple moving average that will probably run along the lines like that. Okay, that's probably what we'll see with that 8 simple moving average. Now, when this market does break down below, or I get a close below this moving average, any sort of candle close, that's a good place to maybe take out, I would say, at least 50 to maybe, I would say take 60% of that trade close. I know a lot of people take 70 or 80%, which is also a good one. But personally, I believe scaling out of a trade, you don't want to take a 50% cut, okay? Because that means if the market does push back down, you've lost a large majority of profit. So rather than taking 50, I would actually say the best way to scale out of a trade is maybe taking 80%, and then whatever's left, you can start taking halves and halves and halves from there on. Because you want to make sure that you keep your profits nice and big, okay? This is completely different to scaling into a trade. Okay, we don't really have any setups or anything that we can play with, so that's a very big important one. So let's have a quick look at some technical examples of scaling out of a trade. We're not going to be using the 8 EMA, we'll just be using some technicals. Now, technicals are a lot more difficult to use when we do scale out of a trade, because generally speaking, if you see a technical setup in the opposite direction of your trade, that generally means the market's going to come down, right? If you did take a buy. So we'll use the same sort of structure. What we'll do is we'll have some support/resistance zones playing out here. We had our nice little double bottom, for example, in this case, which was the indication for us to buy. We ended up taking the trade. Nice, beautiful trade. Stop loss below those lows. Now we have these internal support/resistance zones that we play with. Okay. For argument's sake, all right. Now, when we have something that's a little bit more messy, let's say we've got a messy little correction here. Let's say we have something like this playing out. Okay, we do have, this tends to be a consolidation zone, so we need to be aware of this. These zones are very, very important when we trade. Let's have a quick look at that. So we've taken our trade, right? Now, we know a lot of people actually take their trades based off of the break of this, or they take some profits off the break of that, okay? Depending on what your risk reward was here, if this has reached a 2-to-1, or even a 3-to-1, I would say it's a pretty good idea to close 80% right there, okay? I would say it's a pretty fairly good idea, because the reason is, usually, if this is a very small double bottom, for example, and we've got a lot of strength to the downside, chance are the market's taking a gap and going to go back down. So it could be a good idea to take 80% and move your stop loss to break even, okay? Now, in the chances that this market does break out of this, so let's say we took our trade again based on double bottom, right? Market's pushed past, right? Now we can say, I will actually move my stop loss to break even. You can scale in if you want. Now what we can do is, if this market reaches this resistance zone and starts to reject on here, I would actually close my entire position right there. If I see the market give me a signal to go down. So if I see something like a head and shoulders around this area like this, I would say, okay, well, market's probably going to come back down. Let's rather close my position, because if it reaches a support down here, for example, I can always get back in on that trade. Okay, but if this market was going to come back in here and start to consolidate in here, obviously we don't know whether it's going to break up or down, I would now safely maybe close. If you haven't closed anything here, now you can maybe close, because you've already got a fairly big profit here. You know, if we look at the risk reward ratio here, it's fairly big. So maybe you can look at closing 70 or maybe 60% of your trade right over there as it is here, and obviously then move your stop loss. I would move it below that consolidation area, because if the market breaks out of this, it'll probably drop. Okay, now guys, this is also very important not to get attached to your trades, because I'm not going to hold on to a trade that's going to drain my account. I'm not going to give profits back to the market if I've already reached a significant target. Okay, because like I said before, if this market does break down, I can always take sells, which I'm very happy to do. Or even if I don't, you know, if there's not enough space for a sell, I can always very happily take a buy if that support gets rejected. Okay, but let's say this market is going to continue to the upside, so we've moved our stop loss to break even, and now this market might break further higher. I can maybe scale in with this again. So once we break up here and I get a break in and retest, I can, now that 70% that I took off, I can slowly start adding that back on again. So I can maybe add on, like I would say maybe risk, instead of, I can maybe add 50% of my risk. So let's say, because if I take a trade that I risk 2% with, you know, I can maybe add a trade that would be my original. So let's say your account sits on, let's just say for argument's sake, we've got a small little account, nice $1,000 account. Your 1% risk is $100 on this account. Okay, so if we want to risk, you know, if we want to scale back in on this, we'll take half of that. So we will, you know, we'll risk 1% on this trade, which means we'll end up with another nice 100 risk on that trade. So essentially what we can do is, as we scale out of the trade, right, and we get more entries to go back in, we can scale back in on that trade. So we can constantly, you know, with also having the opportunity of having a runner. So it's a little bit more complicated, guys. You can see scaling out of a trade can be very, very complicated. Personally, for me, like I said, I actually like to just close when I reach a target. I like to close my entire position when I've reached a target, because I feel, for me personally, scaling out is, you know, it doesn't really give you that full opportunity that your trade can give you. I'd much rather scale in on a trade than I'll scale out of a trade or just close that entire position. So if that does make sense, guys, I hope it does make sense. If it doesn't, let us know down below in the comments. We'll be happy to explain a bit more. If there's something you didn't understand specifically in the video, guys, definitely let us know. Don't give us general things. We had someone, can you just explain a bit more, which doesn't, you know, want more to explain. So just say, I didn't understand this specific section, or I didn't understand this specific topic you were talking about in this video. Let us know. We'll be happy to explain a bit more. You know, obviously, we know what we're talking about. So for someone who's new to trading, they might not understand the terminology or completely understand what the words or the functions of certain things. So you can let us know if you don't fully understand it. We'll be happy to explain. We were all there in the beginning. We all started off somewhere, guys. So let us know down below in the comments. We'll be happy to get back to those guys. But from us here at BlackBull Markets, thanks so much for watching. And as always, stay tuned. Trade safe.